In the previous video, we have analyzed Pepsi, and if you haven't seen that, make sure to check it out. And in today's video, we are going to analyze their main competitor, and this is Coca-Cola. And in the previous video, I said that I would rather prefer Pepsi in terms of the drinking, but obviously in terms of the shares, that can be a different discussion. So today we are going to see what could be the real or the fair value for Coca-Cola making a simplified discounted cash flow model. So if you stick to the end of the video, you will see what is my calculation in terms of their share price, and is it okay or not okay, and make a discussion in the comment section, feel free. So if you haven't heard about Coca-Cola, they do a lot of things in the world, but obviously you know primarily them because of the beverage. And the company has been paying out dividends incredibly long time, very reliable dividend grower, and their dividend yield is about 3%, as you can see. The share price in the past year haven't been growing a lot, so if you would check the S&P 500, which we will do, you can see that the share price has been not growing as well. And if we just check how has been performing against the S&P 500, including the dividends, you would see that in 1 year perspective, it has underlined the S&P 500, so it would have been better if you would rather chose to invest in the S&P 500 index. And in 5 years perspective, you can also see that there is a large gap between the two returns. So sometimes I like to say that obviously it has different risks to invest in an index and also to invest in an individual company, but it's very important to benchmark it to something, so you are able to be a little bit more objective in terms of the questions. So let's analyze the company, and if you would like to get the tools included in the video, check out the description, and by this you would be supporting my work as well. I really appreciate. So if you open up the Google Sheets table, you are able to just simply put the ticker symbol on the top left, and all the data will load in immediately, and you are able to see a snapshot on the top, and also all of the important crucial informations down below. So we are going to see that their price to earnings ratio is 25, and their price to earnings ratio forward is below that. So that meaning the company is estimating to grow in terms of net income. Their PEG ratio, which is very similar to the PE, is about 3%. 3. It's not percent, it's a ratio. Their price to free cash flow is 77, which is very, very high. Their current ratio is just about 1, and their debt is obviously high. We are talking about a very mature company, so there is no surprise that their debt ratio is going to be very high. Their dividend per share is $1.94 currently, and then the dividend current yield is about 3%, very similar to Pepsi, and the payout ratio is also 70-40%, sorry. And from this, you are able to see that this one is a mature company, since it would rather pay out its earnings in dividends than reinvest it into the company. Their earnings per share is going to be around 4%. Return on equity is very good. It's a little bit worse than Pepsi, but we are seeing very similar numbers. But actually, their operating margins are better than Pepsi, so you can see some similarities, or we can try to at least match the two companies. If we check at their dividends, obviously people who love dividends are also loving Coca-Cola, since it has been increasing their dividends very nicely. And if we are looking at analysts, what are the analysts or people saying, we can see that there is generally about 15% average upside by them. I would take it with high risks, so don't believe in analysts. Start researching by yourself, but you can generally see that their targets are about the buy or the hold-ish area. And if we are looking at their income statement for the past 5 years, we can see that it has been growing very nicely. Their revenue growth is about averaging with 5%-ish. And obviously their gross profit margins was very nice, and their net income is also quite good in terms of their revenue versus their net income, and their shares outstanding has been not changing as much as you would think. Their shares change are nothing very special as it used to be in the past years, and they are obviously making very nice free cash flow, but not this year. So obviously these details are very highly impacting the current share price, as the market is usually pricing in 1 or 2 years. So if the market or if the company is not able to perform in 1 or 2 years, that can highly affect the current share price. But we can see that their dividend has been growing aggressively in the past 3 years. Well, if you would put it against the inflation, then also you would have a different opinion, but obviously it's up to you how you decide it in general. So if we want to do before we are going there, let's just see their historical price to earnings ratio. There's a difference when you are analyzing a company's price versus when you want to determine their actual value. So when we are looking at the price, we could be comparing it to Pepsi, for example, or other competitors. We can see that their price to earnings ratio is just as usual around the 25-ish. So sometimes it runs up to 30, but maybe it comes down to 23, but the average would be around 25, 26. And their price to free cash flow has been increasing, so this is not a good sign in terms of the price to free cash flow. We've seen that their cash flows have decreased. So let's just go and do a discounted cash flow analysis. And for that, we would need obviously the cash flow numbers, which you can get just by clicking here. And if we go to 2019 and able just to paste all of the free cash flows, when you are doing a simplified discounted cash flow model, it's quite simple. You don't have to think about a lot of things. This is almost everything is automatized. You can just easily change some things and make it your own. And this will determine obviously what will be the share price of the company. And we can see that the 2024 is not a finished year, so this can change in terms of the time, but we can see that their average growth rate in this period was negative 12%, mainly to this negative 65% decrease. But I would suggest to go with a very optimistic, or not optimistic, but pessimistic or realistic 3% growth. Usually I would suggest to put in the growth rate where you are not really able to tell, just put in the average GDP growth for that country and hope that the company is able to perform that. So we're going to project it for 5 years and then discount it back for the present value with a discount rate. This is the weighted average cost of capital. You can see that the minimum and the maximum is about 9% the average. So we are going to take the 9.4% as the average, and we will receive a very, very, let's say, not as good price in terms of the company. So what can you do in these cases? Obviously, you can decrease the weighted average cost of capital. Let's say your margin of error will be only 1% and you take it back to 7%. You see that increasing, but the main factor is obviously the discounted, the growth rate, which you can set to, let's say, hopefully 8% or something which is much higher. Again, it's very hard to do a current discounted cash flow analysis since the free cash flow has been decreasing very, very significantly. So you will see that their cash from operations here is very much down, and their capex has been growing. So this is a very, very hard situation. You can't really put 15% average there because you have to keep these data for 5 years. But if you would just put, for example, if you assume that it should be around the 9,000s, and then you go with the 3 the 3% growth, you will much easily be receiving a closer fair value as the current price. Still not, but they had a very rough year in terms of free cash flow currently in 2024. So you come to an idea that valuing a company is not just about facts, but it's also about what is your belief in terms of the management, in terms of the company health situation. So I will leave with this. I am not able to say a great answer to you. I would say that the current situation is a very hold periodic time, and then let's see what the future brings. If you like the video, feel free to check out my other ones and connect to the channel. So subscribe, like, and also share your ideas in the comment section. What should be the next stock to be analyzed? Have a wonderful day to you. Goodbye.